Hello, I'm Mark Dempsey and I'm a partner in Mayor Brown's fund finance practice. I thank you for watching the following virtual panel on preferred equity. Our panel is comprised of market leaders, participants, and practitioners, including some clients, colleagues, and even some of my own partners. Given the increasing growth and interest in preferred equity as a fund finance product, this panel provides timely information of interest for providers, sponsors, and limited partners. This panel covers a lot of ground, but is generally divided into three areas. First, our panel will discuss the who of preferred equity. Who are the providers and who's taking advantage of this product? Second, our panel will talk about some of the challenges to utilizing preferred equity, including communication with limited partners and potential partnership agreement issues. Finally, the panel will address some key issues in documenting a preferred equity transaction. Thanks again for joining, and please feel free to reach out to me or any of our panelists if you have further questions or are looking for additional information regarding preferred equity.
Welcome everyone to our discussion on preferred equity products in the fund finance space. Joining me today are Tom Doyle, Dave Philipp, Kieran Welsh, Neil Evans, and Mark Uhrynuk, who will each introduce themselves in a second. My name is Ameer Ahmad. I'm a partner in the corporate securities practice here at Mayor Brown, focused primarily on private equity transactions. Tom, if you would please go ahead and introduce yourself.
Hi, thanks for having me. My name is Tom Doyle. I'm a partner and head of credit at 17 Capital. Prior to 17 Capital, I was at JP Morgan, where I set up and ran the structured equity financing business. At 17 Capital, we have one strategy and two products, credit and preferred equity, which basically provides financing and liquidity to investors in private equity. Thank you.
Dave, you would introduce yourself?
Sure. Dave Philipp. I head up the Fund Liquidity Solutions team at Crestline. I spent 10 years at more traditional investment banks lending money to alternative investors, and then spent a decade actually as an investor, either allocating to funds or doing direct investments. I joined Crestline in 2013, really to build out a product line that services the private equity industry, injecting liquidity where they need it. Crestline is a 20-year-old firm primarily focused on credit, opportunistic credit, and alternative credit strategies. And similar to Tom, we have a preferred equity solution set and a true debt solution set.
Thank you, Dave. Kieran, if you'd introduce yourself.
Thanks. So I'm Kieran Welsh. I'm a director and head of fund finance debt advisory at Marlborough Partners. So I joined Marlborough 2 years ago from Lloyds Bank, where I spent 10 years in the fund finance team. Marlborough Partners is a leveraged finance debt advisory firm principally that's been going for around 20 years. And I advise on all aspects of fund financing, including private equity.
Thanks, Kieran. Neil Evans?
Yeah, my name is Neil Evans. I'm a partner in London in the corporate and securities practice in Mayor Brown, focusing on private equity work, and I've worked on a number of these preferred equity solutions in recent times, and looking forward to talking about them today.
Great, thanks, Neil. Mark Uhrynuk?
Hi, Mark Uhrynuk. I'm a partner like Neil in the corporate and securities group at Mayor Brown. I focus on private equity and investment fund transactions. I'm currently based in the Hong Kong office. I've been in Asia for 12 years. Before that, I spent almost 20 years in our London office and started my life with Mayor Brown in New York.
Thank you, Mark. So our topic of discussion today is preferred equity as a solution in the fund finance world. And over the past several years, we've seen an explosion in different fund finance solutions. Obviously, sort of beginning with capital call and subscription line facilities, NAV facilities, asset-backed security facilities, as well as hybrid facilities. But anecdotally, in the past several months, given the impact of COVID and perhaps the difficulty in valuing the underlying assets for NAV-based facilities, we have heard that preferred equity has become more of an area of emphasis for funds, and that demand has certainly picked up in the space. Tom, what's the advantage of a preferred equity solution as opposed to a NAV-based or asset-backed solution?
As I see it, would be the fact that it acts more like equity, in the sense that you can get relatively high LTVs, you can have relatively concentrated portfolios, and you don't have the restrictions that would be typical of a more traditional credit facility, such as a defined maturity, security, with consequent enforcement in bad situations and covenants. That would probably be the main advantages, is that your flexible friend. It's equity-like financing without restrictions.
And Dave, have you seen an uptick in the preferred equity solution in the COVID era?
We have. I think probably similar to Tom. I mean, we've seen a massive uptick in both the debt and pref type solutions here. As everyone's trying to figure out what kind of revenue capital gaps they need to solve for at their underlying portfolio companies, more and more sponsors, I think, are turning more generally to fund finance as a solution. We have seen, probably most recently in the last couple of months, a number of deals that came to us looking either for true credit or a pref solution that have ultimately decided to go down the route of pref. I would say, in addition to what Tom mentioned, we also see occasionally some pressure for groups that want something that looks and feels like a credit solution, but don't want to get succumbed to pure UCC issues or tax UBTI type issues. So pref solves some of those as well.
I think I would maybe just very quickly add to that. I think it's a bit of a mischaracterization to say that COVID has led to this explosion. I think it's led to an explosion in awareness, and it's led to an explosion in sort of an acknowledgement of its utility. Very little of the money that is being put into portfolios through the preferred equity strategies are sort of desperation transactions. I think people have just suddenly said, hold on, there's this extra tool over here that can be very, very useful, not only in rescue situations or where there's a need for money, but also in opportunistic scenarios where people are looking to do M&A activity at the portfolio level.
Kieran, what are the common use of proceeds for these facilities?
Yeah, so I guess as we talk about what's been happening during the pandemic, really a lot of the interest that Tom's talking about is because a number of sponsors have been quite thoughtful around how their underlying portfolio companies are going to perform and if they've got sufficient liquidity, and ultimately whether they might need to put some capital into those companies. So we've seen quite a lot of interest from sponsors where it might be an older fund, and they don't have that much uncalled capital, but they believe that they're going to need to inject capital into the portfolio companies. So that's been one of the sort of reasons why a number of sponsors have been investigating this form of financing in the current market. I guess setting that aside, there's lots of reasons why you would put preferred equity into an underlying, put preferred equity into a fund. And that can be because you might have an underlying portfolio company that just needs an equity injection and you don't have that capital at the fund level. It could be that underlying portfolio company cannot obtain financing on a standalone basis because its credit quality is not strong enough. So thereby, if you put in some preferred equity at the fund level, you can effectively use the credit quality of the fund to get that financing in place. We're also seeing it for opportunistic purposes as well. Just as Tom mentioned, in this current environment, there's some attractive opportunities where you can buy bolt-ons for existing companies. Again, preferred equity is a great tool that you can use for that liquidity. And we've also seen in the situation where distributions to investors have dried up, and obviously LPs are much more focused on their liquidity position as everybody else in the market is. Again, preferred equity can be a useful solution to make a distribution to those investors in advance of a sales process that might have been delayed.
Dave and Tom, each of you touched on this, but how are sponsors viewing preferred equity relative to sort of more commonplace NAV-based facilities or asset-backed facilities?
So, yeah, I mean, I guess I would say one piece, just to maybe add on to what Kieran was saying, a few of the more recent transactions, because I think it ties into how sponsors and LPs look at this. We're seeing a lot of opportunities where sponsors can either buy out some existing minority positions in companies that they already own. So if if they own 60%, management owns 20, and there's 20 older minority stakeholders, especially in this market that are looking for liquidity, it becomes an interesting tool where the sponsor can borrow new money, buy back at a discount, and then ultimately will repay the pref for the the financing through a sale of an asset. And so, at least from what we are seeing, most LPs, think about pref trades as, are they accretive? Are they not accretive? So it really does try to match up with the use of proceeds, especially on something that's more opportunistic in nature. So if a sponsor's approaching them saying, I have an opportunity to either inject capital to do an attractive refinancing where I can save X amount of money, or I can put new equity into a portfolio company to do a bolt-on acquisition, it's A, going to raise your NAV, but 2, may accelerate us to a monetization because it's an accretive acquisition that got rid of customer concentration issue, for example. I think most LPs at this point, maybe back to something Tom said earlier, throughout the summer, we've been having a ton of exploratory and educational discussions, both with GPs and with LPs. So they're much more equipped now to ask the right questions. And I think they're much better at saying, I'm not going to take everything at face value. I have the ability to understand a transaction. So what's the cost of capital, whether it's pref or another financing structure? How long do I think the capital needs to be out there? What's the use of proceeds, and what's the value of that reinvest? And then I need to probability weight that, talking it through with my GP. One difference I would say, COVID now versus pre-COVID. Before COVID, most of the transactions that we were seeing were pretty unique. They were special situations driven by a liquidity need or an opportunity specific to a fund. And those were a more difficult conversation for a GP to outreach to their LPs. Something either positively or negatively had gone not necessarily according to plan. COVID has sort of given every GP the ability to talk to their LPs because liquidity discussions are now so much more ubiquitous. So it is an easier topic to have. I think LPs are more receptive to a GP coming to them and saying, here's an opportunity or liquidity need. And, we can reclassify some of your previous distributions as recallable. We can try to get some new equity or debt in at the asset level. But here's a new tool, and I think it's become just much more part of a natural conversation that allows the LPs to start asking the right questions.
Yeah, I mean, I would agree with everything there. I would just add a couple of topics. One is, I think COVID is more to do with adoption rate. This product's been around for a long, long time. 17 Capital started this pioneering structure in like 2008, and it took time to be adopted. And I think, to Dave's point, what this environment has allowed is people to say, well, what else is out there? What else can I use? And they've just come across this. They think it's bright and shiny and new, but actually in reality, it's just that they're experiencing it for the first time, and it's becoming more and more relevant to these people. They've touched on some really very interesting topics. One of them is the sort of reception of the LP a little bit here, which I'm sure we'll touch on. But what's also very interesting is always this dynamic that it's almost us against the fund, or us against the LP, or us against the dynamic of the fund. These structures are also often used at the GP level, at the ManCo level. We've just spoken today and just touched today on their utility at the fund level. But often the management teams will use these facilities to finance their co-investments into subsequent funds. And it's just realignment. So instead of having the typical 2% or 3% of the fund, they will end up having 5, 10, or 15% co-investment into the fund. So the utility for these products is very widespread, becoming more widespread, and frankly is maybe a little bit different than the common perception.
So Tom, are you seeing GPs start to think about fund finance as part of their fundraising activities and going into new funds?
Yes, for themselves. So you will often have a situation where the private banks or their own personal bankers will finance partners, but often that forgets the rest of the team. The very simple guys can afford to re-up, but often from an alignment point of view, skin in the game point of view, it is really worthwhile having more and more of the team invest, and more of the team want to invest. So we have executed many transactions over the years whereby we take the co-investment pools from previous funds and say, you don't have to give a personal guarantee against these. You don't have to have the typical arrangement. We can finance against those, so that you you and your LP, you and us are completely aligned, because you're going to say, our cash flows, our repayment is structured related to the past funds and the new fund, and the LP sees that they have more skin in the game. So absolutely, it's part of the fundraising topic for these guys now, part of the structuring of the fundraise.
Yeah. I mean, I'd also say on the fundraising side, we obviously have seen some new headwinds come up, and there are a lot of funds in the market that have gone through, have done a first close, and are struggling to get to the right size or the final close, and maybe they've overexposed themselves in the early deals as they were projecting a faster and bigger second fund close. So they're essentially still in their investment period, still in their fundraising period, have assets on the ground but are out of dry powder. And they want to stay relevant, especially in this environment, to buy new assets into the portfolio, which ultimately they think will help with future fundraising. So we're starting to see more deals where they've got 3 or 4 assets already invested. They're trying to build the book to 10. They want to pledge the current assets to allow them to get the new dry powder. And going in on a new acquisition, maybe half of it will be financed with the pref dollars, half of it can be brought in by a specific co-investor to generate more interest in a future fund close. So GPs are getting quite good and thoughtful around, how do I maximize the value of my assets to get a fund all the way to closure? And that flows into warehouse lines and some other structures that I'm sure Tom and I are both seeing.
Kieran, who are providing preferred equity arrangements?
Yeah, so typically it's from funds or institutional investors. And what we'd often see in the market is that there's a number of dedicated funds, but there's also a number of funds that have got a pocket of capital that can provide preferred equity. And quite often now we're seeing LPs themselves. When the GP goes to have a discussion with the LPs that they're thinking about putting in preferred equity, some of the LPs themselves would like to provide that preferred equity, and they might have a team that can do that. And they can have a little bit of a head start because they already know the asset pool and they know the sponsor well. It's definitely something where we've seen a number of, I guess, new providers of liquidity, and probably particularly in the last couple of years, we've seen a number of the large secondary funds being quite interested in the space as well.
I would add, just to be a little bit controversial, perhaps, that there are actually very few dedicated players in this market. I have tremendous respect for Crestline, who I've known for many years. They're a dedicated pool of capital. 17 Capital is a dedicated pool of capital. We've all been doing this for several years. What's been interesting about the dynamic of the pandemic is the secondary market slowed down or stopped for a period of time. So we had a certain amount of, shall I call it, window shopping, where you had a lot of the other plays, with large pools of capital coming in and saying, I wonder if I can get my cost of capital, and they're often too expensive for that area. Also, the secondary market's interesting for us. We have a tremendous amount of respect for the secondary market. Look what it's done. It's huge. They're in the market of buying. We're in the market of supporting. We're not in the market of the seller. We're in the market of the people that have a huge amount of confidence in their portfolios and want to grow it, expand it, need to align themselves with their LPs. So we're in the market of the people that hold. We're not in the market of the people that sell. It's a very, very different philosophy in my view.
Yep. I would say we are seeing, the secondary bankers and the GP solution providers and advisors, and even some of the transactional bankers, as their markets are slowing down, they have definitely started exploring, and so they are, pointing different groups potentially in the pref equity space. We'll see if they end up generating transactions, but they're certainly generating awareness right now in this period of time.
Just to follow up, how common are preferred equity solutions in the marketplace these days?
I mean, it's one of these opaque phrases. Everyone keeps saying the market's like 10 billion a year. We've seen, somewhere in the region of 15 to 17 billion in the last 6 months, right? Some of that's COVID related, but we often see that number ourselves per annum. We don't obviously transact in that amount, but it's definitely north of 10 billion. So it's small. It's small, but growing as its adoption. Again, that's, I think, the really exciting part here, is that its adoption is increasing. And I think a bit like Dave has said in the past, you can group preferred equity and the credit solution. There's a huge amount of talk about these structures in the market, huge amounts of proliferation from, not your good selves, but, some of your peers saying how much of this stuff is being done and is all exciting. And then when you boil it down and peel the onion, you actually see that there's not that many players. Not that many people have done it or have accepted it, but there's usually talk about it. So there's a huge amount of excitement for the future rather than necessarily the secondary market levels. But it will get there. It will get there in the same way as the secondary market in 2007, 2008 was, very small niche market. Now it's commonplace. Preferred equity is going to be exactly the same in a couple of years.
Yeah, we totally agree. I mean, if you think about just the way that secondary started really as a liquidity tool, it was a pure liquidity tool between LPs. And then once the GPs bought in, it became much more of a portfolio management tool. I think we're going through a similar evolution, although it is massively, it's accelerated, I think, maybe because of COVID and maybe just because a lot of the sponsor players had already gone through the adoption of secondary. So I agree with Tom. I think we're in a very good place for the next 3 to 6 months, and then a very, very good place longer term for the strategy the next 3 to 6 years.
I think one of the interesting things that I've observed is that it's becoming a much more accepted product. There's been so much talk about it in the market over the last 6 months that some of the transactions that are getting done are now getting discussed. And obviously the transactions themselves are private, but the sponsors talk to each other. And one of them thinks if those guys are doing it, maybe we should consider doing it. The LPs are becoming much more accepting of it as well. So I think on that basis that it's more widely known. There's definitely going to be a lot more growth in the market.
I think that's a really excellent point. We have done some 59 transactions in space, and I don't think we were able to or want to speak about any of them. What's been a real feature in the last maybe year, 2 years, is people saying, "I'm happy for you to mention that," or for us to be a reference in the market, because now they're actually saying, we're pioneers, so we want to demonstrate to our investors and to our peers that we are actually out there doing interesting things. So that has changed as well, this acceptance, to George's point. But we now can actually reference clients who say, yeah, I'm willing to talk about it with your next client, which is superb.
What are some of the differences between the preferred equity structure and other fund finance solutions like NAV facilities and asset-backed facilities?
So for me, it's a really extraordinary thing, and it's an extraordinary time to be in this space. I don't know if my colleagues here would agree, but the private equity industry is an extraordinarily sophisticated space at the company level. Like looking downstream, the things they do, the way they value it, the way they buy it, the way they structure it. And then you go back up to the fund, and not a whole lot has changed frankly in decades. I can remember, with a few of these gray hairs, I can remember that LP subscription lines was groundbreaking. I mean, there was war about it for a while. That passed. Then you had, the advent of dividend recaps and things, that kind of financial engineering at fund level, that has been accepted. And I think what's really interesting here is that, this is just a continuation of this theme. This will allow, we were recently involved in a transaction here in Europe where it wasn't a dividend recap, it wasn't a investments into the underlying funds. They said, we are going to do this type of product as a normal part of our portfolio management. So how is it different? So it's different in the sense that hasn't been there before. That's kind of the point I was just saying. But it's also different in the sense that it doesn't involve, which was the Comer Gardner version, it doesn't involve the credit of the LP. It's not supported by the credit of the LP, which was often the sort of go-to structure in the past. The LP line, subscription line business will be there, it will continue to flourish. But when you get to the end of the investment period, it kind of stopped. There was nothing else. And I think this is where these products, both the credit and the preferred equity, NAV-based facilities are really are poised to take off. I think this is where it's really exciting. It's finally a space or, a solution to a demand or a latent demand that's been there for years.
Yeah, I mean, to follow on Tom's point, it's crazy to think that private equity firms have basically had to operate as an all equity balance sheet at the fund level, right? And push all of the debt down to the individual portfolio company levels, where maybe that wasn't the best place to support debt or pref, or however you want to think about a financing tool. I would say when we're talking to GPs about, do you want a pref solution? Do you want a debt solution? What are the general thoughts in their mind of how they would go one or the other? This is a simplistic boiling it down, but generally I think it comes down to expected duration. For somebody that thinks they're really looking for a short to medium term bridge loan, call it 1 to 2, maybe 1 to 2.5, 3 years, and they're really looking for more liquidity buffer. I've got an opportunity to put money to work right now, and I'm trying to sell a company that I think will be monetized in the next 12 to 18 months. I'm not looking to bring new leverage into the system. I'm really just trying to manage a time frame. So if they're really looking at very short periods of time, generally we found that they're willing to take covenant restrictions. They'd rather, focus on the ability to repay that facility quickly, manage their duration risk, and look at that as cheaper, lower all-in cost of capital. I'm going to borrow money. I'm going to pay it back in a year and a half or 2 years. It's going to cost me a 1.1 times or 1.2 times. And for that, I'm going to buy 2x of NAV that I'm going to monetize over 3-4 years. If it's a longer duration trade where they actually are more worried about hitting a maturity number where they don't know exactly what the pattern of the NAV is going to be, or they want to get, as Tom said, much bigger, deeper LTV structures, and they want somebody that's going to participate, in the upside, and their return is partially contractual and partially participation based, pref becomes a much more attractive issue. Again, I think most of the borrowers themselves, whether it's they're borrowing through a debt facility or they're borrowing by selling pref, they're pretty good at understanding their dynamics and kind of self-selecting which way they want to go.
But also, think of it this way, as a new tool, it's never been there before. Think about this. In the current environment, you've got management teams of each individual company working flat out to, solve for their current environment. And then the fund goes to each one of those management teams, called a 10, 15 portfolio companies, and we want to do a dividend recap. We'd like to distract you for the next 3 months. We'd like you to get a dividend recap done at each one of these portfolio companies because we need to provide liquidity back at the fund level. And often these dividend recaps enrich the management teams at absolutely the wrong time in the evolution of that asset. Why would you not just talk to the CFO or the capital markets person at the fund, put in a tranche of debt or preferred equity at the fund level, that touches the management company so the alignment is still perfect, doesn't distract them in any way, shape, or form, and you have it done in a month as opposed to 12 times, 10 times, whatever the number of portfolio companies. These kinds of progression in thinking, this kind of progression and just logical use of tools is really what's going to define this market.
Yeah. I love, Tom, your example is perfect. And think about expanding into, you're going to borrow 100 million of pref dollars, and some of it's going to go satisfy LP issues. 30 of it's going to go satisfy potentially a covenant issue of one company. Another 30 is going to go finance an acquisition at a, you can use multiple uses of proceeds specifically, around one single transaction. So it also is an efficiency tool at the fund level and just broadens the use of proceeds. One of the things we are seeing right now in COVID is just a desire for more flexibility. Groups that say, we don't want to specify all the use of proceeds up front. I want a big facility, but I only want to take down a certain amount. So I want a delayed draw feature. I don't know how long the pandemic's going to cause, a revenue disruption. So I don't know if I really want something that's, I want to be able to pay it back in a year and a half or 2 years, but I may want it out there for 5 years. So the flexibility is really what's being demanded by the borrower right now, which again goes to serve, groups like 17 and us, where we've got a little bit more flexibility than maybe your more traditional banking institutions.
Yeah, no, I definitely agree with that, Dave. What we're seeing when the sponsor is thinking about either a debt solution or a pref equity solution, they're often very focused on the flexibility that a pref solution can give them. And they can quite often be very nervous about putting something in at the fund level that has got covenants. I guess in the private equity industry, it can be quite accepted that you may lose one company. If you put financing in place, but your other 10, 11, 12 companies will perform. However, sponsors can still be a little bit nervous about putting something at the fund level, where there's covenants there, and if a covenant trips, then you've got all your assets on the hook until you can solve that issue. So that's one of the great things about the preferred equity. It's much more flexible, and you've just got something that sits there and you don't have to worry about it as much.
And Kieran, how are you seeing pricing for preferred equity versus a NAV-based facility?
Again, for me, I would just maybe pick up on this NAV-based facility topic. Again, huge amount of talk. If you actually boil it down, you'd kind of be surprised by the number of transactions that have actually done it. They tend to be either groups like ourselves at Crestline doing them, and I would say we take a kind of a view more of a credit investor. It really suits the need. or you have relationship bank transactions. I think that is maybe what you're referring to when you talk about NAV financing, because other than that, it doesn't exist. I can probably name on maybe two hands the number of transactions that I'm aware of ever for funds other than relationship transactions. And those relationship transactions tend to be for the big guys. So, the 3,950 other funds don't have a home, right? That's how interesting this market is. Pricing, our pricing is very transparent. It's very similar to Crestline, I guess. We're sort of trying to get for our investors sort of double digits net for preferred equity transactions, and for our credit transaction, our credit fund. The reason we introduced that is that it's kind of the same philosophy, but not everybody needs a really high LTV. Not everybody has a concentrated portfolio. So we introduced that credit product, more diverse, and as Dave said, more kind of more certain cash flow. A topic where maybe the LTV is much lower, and they were trying to go for high single digit clients.
And I echo it. I do think that there are some larger banks doing the NAV plays. I think there are a few, kind of sub $50 million transactions that are out there that just kind of go under the radar. And a lot of the GPs haven't historically wanted to bring that up. Often if you're in a liquidity issue, either you're trying to buy something or you're trying to make an optical statement to the market. The last thing you want anyone, including your portfolio companies, to know is that you've got potential liquidity issues. So I think a lot of them are just done underneath the radar again in kind of that sub $50 million size. And I would say in terms of pricing, they are, they can be, mid single digits for some of the really large transactions that the banks are willing to do with no structural flexibility. And as long as it meets their regulatory capital treatment, they can go to those levels. And we've seen them as high as, 15 or 20%. So it really depends on, first and foremost, the collateral. Secondly, what's the use of proceeds? What flexibility needs to be in here? Oftentimes somebody would rather pay a low double-digit return number as long as they know they've got the ability to repay the entire facility in 12 to 18 months. And again, I'm buying a big piece of NAV value in the future, and I'm paying up on a high coupon basis, but I'm capturing as much of that MOIC for my end LP. So a lot of it has to do with the flexibility in terms of the overall structure that relates to price.
And one other topic, kind of like the elephant in the room, has been, we sort of, in a jokey way, we call it the bank of do nothing. It's probably our biggest competitor. Is the Bank of Do Nothing Incorporated. For many, many years, there was no home for these things, or they thought it was going to get rejected. They didn't know what was available. And frankly, they still don't. The kind of discovery on these structures is still not credible. That's where people like Kieran have a really important role in the market. But the Bank of Do Nothing has done great business over the years, because it just, many times this product didn't exist, or they didn't know how to access it.
I would totally agree with that, Tom. I would say, as you mentioned earlier, 17 Capital in Europe have been around for 10 years or so, more than that. In terms of bank debt NAV solutions, these have only really been getting pitched in the last few years, and there's actually very few deals that have been done. A number of those have been done this year, as a result of the pandemic. I think that's a market that's probably going to grow, but it's just not as big as the preferred equity market at the moment.
We touched on this earlier, but any trends that have emerged in the COVID environment that have impacted or accelerated the adoption of preferred financing, other than what we've discussed before?
Dave, do you want to?
I would say that the biggest thing for us is, if you just want to boil it down, I think we probably touched on most things, but it's one, significantly more awareness. Obviously webinars like this, getting the message out to GPs is helpful. There have been tons of articles over the last 6 to 9 months about, how fund financing can potentially solve capital gaps for sponsors that don't have, any more dry powder. I think the idea that it's a much easier conversation between GPs and LPs has become, significant. And then finally, there have just been a lot more reference transactions, as Tom said. GPs are proud of what they've done because they can go and show a full life cycle now on some of these trades that have netted, an accretive result to their LP. So people are more excited to talk about it. And then finally, again, you've got the bankers that are, pushing against some strings sometimes in, M&A transactions right now, or the secondary market transactions. And so they're just trying to understand how fund financing may be able to solve for some of these gaps. So I'd say that's, those have been the big drivers that have, built up a lot of awareness. And as, Tom aptly mentioned, we're pretty optimistic as as an industry that awareness is going to lead to adoption pretty quickly.
I would maybe just add to that. I think that's absolutely correct. I would just add to it. We kind of have a theme internally when we talk to our investors and to clients. Is we call it the Trilogy theme. Phase one was COVID environment. The recognition, adoption, acknowledgement of this product, and it was used to cure leverage finance transactions, direct lending transactions. It was used to put additional equity into funds. Very quickly pivoted towards opportunistic dry powder and creating pools of capital to take advantage of the future, and frankly to take advantage of some issues that they may have in the future, just creating that pool of capital. Part two in the trilogy is going into the management companies, because liquidity will slow down. It will take time for people to recover, to get back to the EBITDA levels that they want to get back to the multiples that they want to sell at, frankly, to get the demand for these companies back. So management companies will need liquidity to get through this next phase, because it is a very fertile environment for them to invest in. So they will need money. So that will lead, in our view, to increased demands for preferred equity and NAV financing at the management company level to finance investments to further align, or frankly to seed new strategies on their balance sheet, or to manage succession. All of these things will take time. And the third movie in the trilogy, as it were, is LP. LPs have gone through an incredibly liquid period. Again, the growth of the secondary market, it has been an incredible period of liquidity. Many of them, for good reasons, have gone into overcommitment strategies, etc. So they have some great assets, but the liquidity will be delayed, and we can see an environment there where LPs will need us as well. Again, back to our origins, that was often what we saw coming out of the last crisis, and we've seen a couple of the cycles. And the third part of the movie might indeed be at the LP level. So there are some of the themes that we have seen progress, or at least we can kind of forecast a little bit going forward.
Yeah. And one more thing, Ameer, and I'm sorry, I meant to say this. I mean, I do think that the secondary market is clearly on pause for a little bit, but there's so much dry powder and there's pent up demand. I mean, this is going to it's going to work itself out. I do see pref equity solutions and NAV-based solutions fitting into more secondary type transactions. So we're looking at things that might have a 1 to 2 year bridge, as part of an overall fund restructuring, so that the manager can support the assets while the fund restructuring is taking place. We're looking at bridges to annex funds, continuation funds. So you're using multiple solutions that some already exist in the market. And they're not necessarily competitive. They're more complementary pieces where, what Tom and I can do with our fund discretionary capital is act, in 30 to 60 days, because we're not necessarily putting down equity markers. Ours is a lot about structuring. So we can come in, deliver capital quickly, and then ultimately let, the repayment of that come from the long-term equity holders as they can get comfortable, as the portfolios get built up. But you don't put a GP in a liquidity crisis for that 1 to 2 year period while those subsequent funds are being raised.
Kieran, seeing how COVID has impacted different businesses differently, particularly the healthcare industry or retail-focused businesses have been disproportionately impacted. Are you seeing sponsors that are focused on those sectors exploring preferred equity solutions more than more diversified funds?
Yeah, there can be a bit of that where it's the sponsor, again, thinking about the situation where they might have an older fund, that there might not be that much uncalled capital, and they might look for an additional source of financing. So if you've got a portfolio where you've got some concentration in some of those assets, or some other sectors that have been badly hit, then for sure you're going to be thinking about another solution that's out there. And this really goes back to, I guess, the point around why has there been so much awareness of this product? It's because sponsors have been faced with this issue, and they've been looking to see where can they get some additional capital.
Tom, you touched on this earlier regarding LPs, but how have they reacted generally, and are there any challenges to how it's communicated to the LPs?
I have a really simplistic view on these things. If you have poor performance in your fund as a manager, if you have poor performance, if you don't have a great relationship with your investors, none of these products are suitable for you. They will be rejected, they will be criticized, they will cause grief and friction between you, the manager, and your LPs. And we've seen that. We've seen people trying to do, an American term, the Hail Mary throw in order to solve some internal issue they have, either whether it's trying to boost performance or meet carry and all these kinds of things that are selfish. Now, the private equity industry isn't altruistic in this regard. They are trying to maximize and optimize value for their investors. This is what I love about the preferred equity industry, because you are basically trying to support confident investors, people that really, really believe in their portfolios. They're not selling them, they're keeping them. They're trying to finance them. To Dave's point, they're trying to go in at our level of financing and, come back with 2x the money. So one of the things that has always been there, and I think will always be there, is this friction between what the GP wants to do and what the LP thinks is acceptable. And funnily enough, the bridge for that is performance and relationship. If that is functioning and if your performance is adequate, you really won't have a problem with these things. Now, think about it from our perspective. Myself and Dave, we are GPs. We have relationships with LPs. Our LPs invest money to do exactly these things. So there is an acceptance already by the LP community in what we're trying to do. But you won't do it, and you shouldn't do it, and you shouldn't do it with us if you think you're going to try and pull the wool over an LP's eyes or something. These facilities are always best done, and frankly, it's our first question: do you need to socialize this with your LP? And even if you don't, you probably should, because we all have valuable time, and we don't want to go through 3 months of work and then for your LPs to shoot it down. Our review of the performance of the GP is really key to our investment, because we want not only confident investors, as I pointed out, we also want successful ones. Right? That's also very key, because they need to pay us back the money. So that whole dynamic for me makes this a little bit of a moot point in some respects. The bad managers with the bad performance and the bad relationships won't be able to do these or shouldn't do them, and the ones that are doing them and the ones that are lost, and presumably with our peers, are the ones that have good relationships and good performance and can justify the use of these structures.
Yeah, I totally agree. I mean, GP alignment and GP motivation are key. So we always try to figure out if people are, in the carry, how much of their own capital is in this. Again, trying to avoid any kind of zombie scenario where it's really about an extension of a fund just purely to collect fees. And as Tom said, we really take it seriously to make sure that a GP has socialized this with at least their LPAC before we start doing a lot of work. That was a valuable lesson we learned in a couple of our early trades where the GPs honestly didn't know. They just assumed, they thought it was such a great idea that, of course, their LPs would naturally be on board. And so it was a good learning experience for everybody.
Yeah, no, we've been involved in those processes as well, where there hasn't been a discussion with the LPs up front. And you agree the deal, and then the LP say they don't want to do it. So now our first question before we start is very much: have you had the discussion with the LPs, and how do they view it?
Neil,
one last point I'll touch on here, because I do think it's important. I mean, we have had deals where the LPs as a body have been supportive, and specific LPs, stepped up and wanted to do it themselves. And it was frankly an uncomfortable position for a GP to be in, to have some of their LPs coming in on a different preference level than others. A lot of times these transactions are relatively fast moving because you've got a need for the capital pretty quickly. And some of the bigger, more institutional pensions just can't run through their board processes fast enough to commit to putting in new capital. So you end up with sometimes, odd structures where some of your LPAC is senior to others. So where we've come in the past to try to help solve this is we'll do our pref transaction, or we'll do a NAV transaction, and we'll underwrite the entire piece, but we'll allow some of the existing LPs to participate alongside us, especially if some of them would like to. That also puts them in a nice position of they can capture the economics if they think it's a good trade. But if anything does go wrong down the road, they don't have to face off against their GP, and their LP stake is a passive investment in a new vehicle. It's not putting them in a preference play relative to some of their other LPAC members.
I would very, very quickly add, we do exactly the same thing. We often find that it's a very good mechanism for the GP to socialize this with his LPs, to say, if you want a piece, you can have a piece, as long as you're not running it and you're not subordinating your peers as LPs, you can come through 17 Capital. And actually, to acceptance and the way these things are progressing and the adoption rate, I just reminded when Dave was speaking, we did a transaction in the US a couple of months ago, and we always reference, these transactions with, people we know in the market, investors, et cetera, how it's going to be accepted and what they think of the managers, et cetera, normal due diligence. And one of the investors in the fund subsequently came into our fund. He said, actually, we really love what you're doing. And actually, we want to give you money. So it's actually, it was a wonderful virtuous circle where not only did we get a transaction, we got a great reference, but we also got a new investor. So LPs are adopting this. And it's okay as long as the performance and relationship is normal.
Neil, what issues does a sponsor need to consider with respect to their LPA when they're considering a preferred equity solution?
Yeah, well, this is a key part of the homework to be done on the borrower side before we sort of get into the process proper, as Kieran mentioned. And when we've been advising on the borrower side, we've encouraged a proper analysis of the LPA. But as Tom and Dave said, the relationships with the LPs are the starting point. That's the most important thing. It matters what it says in the LPA, but if you've got relations with your investors, the likelihood is that you're going to get consent anyway. If it's bad, it's going to be a non-starter. And sometimes, if it's in the middle, and it is important to work out whether the investment manager has got discretion, it's really a case of having a long, hard think about, are you actually going to need to go out and carry out a formal LP consent process? Because, as Tom said, these are fast-moving processes, right? Often there's a purpose here for the funds that is where time is of the essence, and we've had previous examples, like Kieran, where we've been looking at a pref equity solution. And where there is a significant concern about getting LP consent, particularly depending on what it says in the LPA, the clients have gone down a different route in the end. So I wouldn't just say it's a case of getting the LPA out itself, and it is a matter of placing that in the context of investor relations, the process, and the purposes for where you're going to apply the pref equity funding.
Dave, any difference between fund level, portfolio level investment?
Yeah, I think a couple of the speakers have talked earlier about, in a lot of portfolio, private equity strategies, the hope is that the portfolio itself will gain in value, and potentially losing one or more underlying portfolio companies in the process, may or may not be, kind of par for the course. So I think what we've seen is, if an LP has any choice, and if the pricing is close, you clearly want to ring fence that exposure to a single asset. But what we've seen in many instances is that, the company that needs the capital, that can generate the accretion, or has a lot of protective need for existing equity that's been already injected, they can't get the capital by themselves. So it really is this idea of, a lender in pref or NAV form being able to cross-collateralize, to credit enhance it, to ultimately allow a sponsor to deliver, cheaper cost of capital down to the company that needs it. So all this stuff ties together with GP motivation, GP alignment, relationship between the LPs and the GP. But it's usually, okay, I've got a company that needs capital. I can't find it in a traditional source. The pref or the NAV solution by the sponsor, collateralizing this is often the most cost effective. Okay, is that something I want to go down? Now, again, I have to go back and run, my thoughts around, is this an accretive trade? Does the manager have an ability to get us out of this trade at some point in the future? What is my confidence in the GP? Is this good money after bad? I mean, those are the questions that an LP needs to talk about. And I would say consistently, the conversations by the time they come to us, they've explored portfolio company solutions, either in debt or new equity form. Often what we're seeing specifically right now is where you've got that company that could raise equity, but they wouldn't raise equity at a valuation that the sponsor is encouraging. Because the sponsor may not have access to dry powder, they may be punitively diluted. So the idea is, if I can just put 20 million of more growth capital to execute a specific plan, if I can put 30 or 40 million to finish off a manufacturing plant that, is trying to expand to take advantage of COVID, all I need is 18 months, and then I can go raise equity at a much, much higher valuation. So, borrowing a pref piece for 1 to 2 years is significantly valuable by not having to permanently dilute at today's prices. I think that's the current argument that the GPs and LPs need to work out. But I would say an LP would always prefer to have it ring fenced to a single asset, and a GP has to be able to overcome that and show the value and show the accretion.
I mean, I'd quickly add, I don't think they're mutually exclusive. It's not. It's very rarely, in fact, an either/or situation. It's usually probably both. Today's point, you want to ring fence. You want to have the tax shield at the company level. Knock yourself out. Do that. But we're trying to do, I would say, something more strategic at the fund level. In addition, now we obviously will look through from a risk manager point of view. We'll obviously look through the collective or aggregate leverage to see if we want to participate. Obviously, that's our diligence, but it's not mutually exclusive. It's usually both. They will optimize at the company level, and they will look to do something more diversified across the fund.
Neil and Mark, are there any particular features regarding the documentation and implementation of a preferred equity solution from a legal or diligence perspective?
I think from my perspective, the great thing about this product is that the diligence and the documentation is a lot more straightforward than a traditional debt arrangement, right? So diligence tends to be lighter touch, given it's over a wider portfolio. And as we've talked about already, these transactions are covenant light. Events of default or equivalent provisions are high level and shorter than you would expect to see in traditional debt documentation. Rights, which is often a big subject of discussion when you've got competing investors trying to come to a landing. These are portfolio level, not granular discussions, and tend to be easier as a result. I think in our experience, certainly I think you can probably get a pref equity transaction done start to finish, provided you've done the necessary preparation, in less than 2 months. Sometimes even we've done some considerably quicker than that, which, given the purposes of these solutions are often sort of time driven, is something that on the execution side we see as a real advantage.
Maybe I'll just jump in a bit and talk a bit about the product in Asia here, and just relate back to something that Tom mentioned about the evolution here, because clearly the product, if you look at fund finance generally, Asia has been kind of just getting involved in that, starting with subscription line facilities where they were quite topical. When I arrived here 12 years ago in Europe and the US, they weren't very much talked about. Now that's changed, but when you get to the structured solutions like preferred equity, it's still very, very early days here. You've got your global sponsors here that operate regional funds, and no doubt they're aware of it and maybe looking to apply it. But when you've got the bulk of your funds being smaller growth equity funds operating in multi-jurisdictional areas, I think it's still very, very early in the evolution of the adoption of the product out here. That being said, we've had the whole secondaries market has developed here. There are some established secondaries funds that have been active over the last few years, and we're seeing them raise this question about this product with us in Asia. So it's on the radar screen, but there are likely perhaps some documentation issues that are maybe special to Asia. You may have the GP alignment point with the LPs and the GPs is evolving as well. But there may be some older approaches where the GPs aren't as communicating with their LPs as they should be. We've recently seen that changing. But when you've got a market like Asia, where there's a lot of developing economies with developing regulations, laws, that creates a hurdle in the diligence and maybe the hurdle in the execution, particularly if you're trying to fund a portfolio company in China and getting your cash out of China. There are a lot of issues that exist, I think, in a kind of a pan-jurisdiction market like Asia, and with a number of developing economies that funds may be invested in Asia, that will create some challenges to both the due diligence and execution timeline, I think. But there's no doubt that it's a product that will see some activity here, and I'm certainly seeing interest from our clients and contacts in the sector.
Yeah, Mark, I would actually just jump in and say sometimes when you've got a portfolio across, across Asian underlying portfolio companies that span multiple jurisdictions, the documentation can be tricky. I mean, we've done a few in Southeast Asia and a couple in India, but it also allows you to take some of the FX risk out, or certainly some of, the export of capital risk out, because you've got multiple assets sitting outside of China that form part of your collateral package. And maybe, again, it's the company inside China that needs the money, and they're having a difficult time with exchange control issues. But again, you can cross-collateralize that risk just like you can cross-collateralize single country risk if you've got a portfolio of Pan-Asia. We have not done a very local portfolio with local investors. Most of ours have been, regional exposure with international investors that have already seen some of these specific, deals in other portfolios, and they understand how they work. But I would say, we've done a couple. Jurisdictionally, it is tricky and a little bit more time-consuming and expensive if you're running everything through, Mauritius or Malta or wherever.
Sure.
Just very, very quickly. I mean, one of the things when I look at it, and I spent some time in Asia, from a research point of view when I was up at my last employer, but if you take a lot of the topics that we've discussed today about, GP acceptance, LP acceptance, I think the Asian context is a really great kind of unifying theme. They're a little bit not behind sophisticated, but they haven't adopted these types of products yet in Asia. And probably more importantly for me, the LP community hasn't really adopted this. And it really just shows the journey that many of the other jurisdictions have been on that will absolutely inevitably be followed here. It's just a matter of time. But I think it was interesting just to, all of the things we've challenged ourselves over the last 10 years here about LP acceptance, GP acceptance, how do you use it? It's kind of like just seeing it there in action right now.
Yeah, one observation, and this started pre-COVID, but it's relevant, is the relevance and the importance of ESG in the dialogue, and the investors, like the development financial institutions and some social impact investors, that GPs are now really interested in forming relationships with, because of the value that they can bring in executing transactions in countries where regulators or counterparties see that as a very, very valuable attribute to what they have. So we've seen some classic funds, GPs, shift and adopt a very LP-friendly, ill-performed documentation, bring in cornerstone investors of DFIs. Lots of co-investment with those types of investors as well, which is really, I think, accelerating in a way that GP-LP alignment, particularly if you're in a country or a sector where we're having that kind of ESG kind of investor and part of your portfolio of LPs, but also a key co-investor in some transactions. We've just seen that ramp up through this year, but it started maybe 18 months ago in some of the funds formation work we've been doing.
Kieran, what's a typical timeline to get through diligence and documentation on a preferred equity transaction?
Yeah, we would typically say that, ideally that you would want to leave up to about 10 to 12 weeks. Clearly that it's not often the case that you might actually have that amount of time. And we can see these getting done, in a shorter time frame as around, 6 weeks potentially. Clearly, if you speak to me, you've probably got an extra 10 days or so in there than if you speak to Tom or Dave, because we would run the process across the market. So they'll have a slightly shorter process if you've already mandated them to go. But really, it comes down to how long have you got to be able to do this? And the timescales can really be compressed quite quickly on this. And that's one of the things about it being a really flexible product that it can get done quite quickly.
Yeah, I'd say diligence. Diligence is generally a 30-day period for us, and it's fairly standard. The issue comes down to documentation and just the sequencing with, when a GP will go out to their LPs and run the consent process. That seems to be the time frame that needs to be most controlled. And if the GP can get the sequencing right, and they're willing to parallel process rather than running everything sequentially, you can maybe get it down to 60 days.
Yeah, I'd say that key to all of that is preparation, especially on the sponsor side, right? And that includes being upfront and forthcoming about the issues in the portfolio and the purposes for which you're going to be using the funding, and thinking about how are you actually going to give the provider some comfort, right? Whether that's through diligence or in the documentation, and preparing for that rather than doing it during the process, which can actually just which can push the timing out a little bit. So when we've got involved and worked with folks like Kieran, I think that's been a real emphasis is preparation to drive the timeline down.
I think, I would look at things really, really simply. When we go into a preferred equity transaction, we are essentially the senior equity investor in the fund. So from a timeline point of view, from a diligence point of view, we see ourselves as investors. We often become the largest investor in many of these funds on a senior basis. So, for GPs analyzing this process, how long does it take for their LPs to come in? How long does it take them to diligence, them as a manager, their portfolio, and therefore the structure that we're going to come up with? And it is a partnership. So in the same way as the LP, we see it as, we're a senior LP, if you get the point.
Maybe one point, just for
how long is that piece of string to be an investor in the fund?
Yeah, one thing that we've seen in some of our transactions where there is kind of a close use of proceeds on the need side, we're happy to work with the GP to let whatever the capital requirement, if it's to refinance something, if it's to extend an exclusivity provision, we're very happy to be transparent around writing commitment letters and fund commitment letters so that the GP is armed with a lot more leverage in terms of extending the potential deadlines. And so we try to make sure that, all of that's going on concurrently. So if there is a back end date that you have to hit, to the extent we can help make that a little bit more malleable, we certainly do.
Perfect. Tom, Dave, or Kieran, any final thoughts?
I mean, if you push me, I just have never been as excited about this product. I mean, it just is poised to, be adopted and be adopted more. I mean, and that's not us pushing anymore. This is us then pulling a little bit. And what's been pleasing for me actually has been, it's sort of a strange comment, but actually has been the trades I haven't done in the last couple of months. We either elected not to do them, or frankly, they elected to go with somebody else because it's a market. But these were large groups, different groups that we had, seen in the past, and either said no to them in the past, or they've said, well, we'll never use pref. It's just not for us. So it's things like that has been very pleasing for me, the way the market has been developing, irrespective of us or not.
Yeah, same here. I mean, the amount of interest has been very rewarding after all the time that we've all put into kind of groundbreak the market across different segments. One thing maybe going forward will be less of a pure liquidity provider and more of a trade idea generator. A lot more of the conversations that we're having right now are consultative. It's not, I have this specific need. It's, hey, how do I maximize value over the next 2 or 3 years through my harvest period if I had an extra 25, 50, $100 million? And so just running through more case studies of what our other GPs and borrowers have done and see whether it's applicable across sponsors. I think that's, and those are very rewarding conversations. There's no sales pressure. Nobody's in, the sponsor's not in a sort of immediate cash crunch. It's really exploratory and thinking through opportunity sets based on what the market's going to give everyone over the next, again, 6 to 12 to 60 months.
I think from my side, I guess what I would say is, whilst it's still a niche product, I think that the awareness and the acceptance of the product is actually quite widespread now. And from, I guess, from my perspective, that can only lead to more transactions getting done in the market. Because when those requirements come up in the wider community, then it'll be something that they're familiar with, something that they know that other sponsors have used. The LPs are going to be accepting of it as well. So that can only lead to more deals getting done in the market.
Great. Well, we're a bit over time, but I think this discussion has been excellent. So our thanks to Tom, Dave, Kieran, and my partners Neil and Mark, and to any sponsors that have been watching or listening. We encourage you to reach out to Tom Doyle at 17 Capital, Dave Philipp at Crestline Investors, Kieran Welsh at Marlborough for any questions or conversations regarding preferred equity as a solution to your fund. We thank you all for your time. Appreciate it, and have a great rest of your day.
Thanks for having us.
Thanks, Amir. Thanks, everyone.
Thanks, everybody. This was great. Thank you.